you did it. You fought the battles, you won the war against debt, and you've built a fully funded emergency fund that stands like a fortress. You have officially arrived at the doorstep of baby step 4. And for many, this is where a new kind of fear sets in. The world of debt was simple. It was the enemy, and you destroyed it. But the world of investing is a dense, confusing jungle of jargon, hot tips, and conflicting advice. The fear of doing the wrong thing, of losing all your hard-won progress, can be paralyzing. What if I told you that Dave Ramsey's entire investing philosophy is designed to destroy that fear? What if his strategy isn't about being a Wall Street genius, but about using a simple, powerful, and disciplined plan that anyone can follow? Today, we are taking a deep dive into the heart of his wealth-building engine, the 4 mutual fund strategy. We're going to demystify it completely. We'll break down what each of the 4 fund types is, understand its specific job within your portfolio, and see how they work together to build lasting, generational wealth. This isn't about stock picking or trying to time the market. This is the masterclass on how to move from being a debt slayer to a savvy, confident, long-term investor. The foundation. Why mutual funds? Before we get to the 4 specific types, we have to understand the bedrock of this entire strategy. Why mutual funds? A mutual fund is simply a pool of money collected from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. Instead of trying to pick one winning company, which is like gambling, you are buying a tiny piece of hundreds or even thousands of companies all at once. Think of it like a pizza. Trying to pick the one perfect stock that will make you rich is like betting your entire life savings on a single pepperoni. If that one piece of pepperoni turns out to be bad, you lose everything. A mutual fund is like buying the entire pizza. You get a little bit of everything: the pepperoni, the mushrooms, the cheese, the crust. Even if one topping isn't great, the overall pizza is still a solid, reliable meal. This is called diversification, and it's the closest thing to a golden rule in investing. It's the strategy of not putting all your eggs in one basket. Dave Ramsey advocates for this approach because it's a proven, systematic way to participate in the growth of the broader economy over the long term, dramatically reducing the risk of being wiped out by a single company's failure. Now, let's look at the 4 slices of the pizza he recommends. Ramsey's advice is to invest your 15% equally across 4 types of mutual funds, 25% into each. Fund 1, Growth and Income, the anchor. This is the bedrock of your portfolio. These funds invest in large, well-established blue-chip American companies. These are the household names you know and trust. Think Coca-Cola, Johnson & Johnson, Microsoft, or Apple. They are giants of the industry that are not likely to disappear overnight. Its primary job is to provide stability and reliable long-term growth. These companies are so large that they may not grow at a lightning-fast pace, but they are consistent performers. They also often pay out dividends, a share of their profits to stockholders, which provides the income part of the fund's name. If your investment portfolio is a skyscraper, the Growth and Income Fund is the deep, concrete, and steel foundation. It's not the most exciting part of the building, and you can't see it from the top floor, but without it, the entire structure would collapse at the first sign of a storm. Fund 2, Growth, the engine room. This fund also invests in large and medium-sized US companies, but these companies are in a more aggressive expansion phase. They are past the startup phase, but are still heavily focused on growing their market share and revenue. This is the primary horsepower of your portfolio. While the Growth and Income Fund provides stability, the Growth Fund is expected to deliver stronger returns over the long term. These are solid, successful companies that are still on a powerful upward trajectory. If the first fund was the foundation, this fund is the powerful engine of your financial vehicle. It's what takes you from 0 to 60. It's not a risky experimental jet engine, but a reliable, high-performance V8 that consistently drives you forward year after year. Fund 3, Aggressive Growth, the turbocharger. This is where you add a little bit of spice to your portfolio. These funds typically invest in smaller, more innovative companies with the potential for explosive growth. Think of emerging tech companies, biotech firms, or businesses disrupting entire industries. The job of this fund is to provide a high-octane kick to your overall returns. Because these are smaller companies, this category comes with more volatility and risk. Some companies will fail, but the ones that succeed can deliver spectacular returns that boost your entire portfolio's performance. This fund is the turbocharger or the afterburner on your engine. You don't rely on it for the entire journey, and it can be a bit bumpy when it kicks in, but it provides a powerful thrust that can significantly accelerate your speed and get you to your destination faster. Fund 4, International, the Passport. This fund invests in successful, large companies located outside of the United States. Think of well-known global brands like Toyota Japan, Samsung South Korea, or Nestlé Switzerland. This fund serves a critical purpose: global diversification. The US economy is powerful, but it's not the only economy in the world. Having an international fund ensures that your entire retirement doesn't depend on the success of a single country. If the US market has a down decade, your international holdings can help balance out your returns. This fund is your portfolio's passport. It allows you to invest beyond your own borders and participate in economic growth happening all over the planet. You wouldn't build a life where your happiness depended only on the success of your hometown. You shouldn't build a portfolio that depends only on the success of your home country. So let's recap the team you're building. You have the Growth and Income Fund, your stable, reliable anchor. You have the Growth Fund, your powerful primary engine. A cow. You have the Aggressive Growth Fund, your high-performance turbocharger. A cow. And you have the International Fund, your passport to global success. Together, these 4 funds create a simple, diversified, and powerful portfolio. The beauty of this strategy is its elegant simplicity. You are not trying to be smarter than the market. You are simply owning a piece of the best companies in America and around the world and participating in their long-term growth. Your job isn't to pick stocks or watch the market every day. Your job is to set up your automatic 15% contribution, spread it evenly across these 4 types of funds, and then leave it alone for decades. Your job is to be patient and consistent, not to be a genius. So, what is your immediate next step? Your homework is not to go out and buy these funds tomorrow. Your first step, and the one Dave Ramsey insists upon, is to find a qualified investment professional, a SmartVestor Pro, or a fiduciary advisor who can help you select high-quality mutual funds that fit these 4 categories. Your first step is to schedule a conversation. It's to take this knowledge and partner with a pro who can help you execute the plan with confidence. You've already proven you can conquer debt. Now, with this simple but powerful strategy, you have the blueprint to build true, lasting wealth.